Good morning and welcome to our EY webcast focus on the impacts of COVID-19 on the wealth and asset management industry. I'm pleased that we've been joined by so many of our clients from EMEA and around the world. My name is Alex Birkin and I am the Global Wealth and Asset Management Consulting Leader and EMEA Industry Leader for EY. Well, 3 months ago, I could not have imagined speaking to you all from my home here in West London with my 3 young children attending virtual school downstairs. After only a few days of 3 children struggling with MS Teams, I can assure you I've got the better end of the deal being sat up here talking to you. Although we are here today to discuss the impact of COVID-19 on our industry, the human tragedy of this crisis is never far from our minds, as are those family, friends and colleagues whom we've lost over the last 7 weeks. Let me turn to our agenda now. Our agenda today is focused on the impact of COVID-19 on the wealth and asset management industry now, next and beyond. Our insights are informed by our teams spending many hours speaking and working with many of you and our other clients around the world. We believe new trends will emerge and existing trends will accelerate as a result of this pandemic and economic crisis. We believe we will not come out the way we went in. As the pandemic and the economic crisis develops, our thinking continues to evolve, and we welcome and greatly appreciate your comments and questions and continued insights. You can ask questions today and provide your comments by using the Q&A function on the right-hand side of the screen. We'll try and address your questions throughout the presentation, and we'll leave some time at the end as well. Please note that all participant lines have been placed on mute. So now let me move to introductions. I'm very pleased to be joined by a number of my colleagues today and wealth and asset management experts from EY. We have 2 fund liquidity experts, Dr. Anthony Kirby and Vincent Galin. We have our asset valuation expert, Christophe Vantendorp, our sustainable finance leader and leader of our UK wealth and asset management practice, Gillian Lofts, and our strategic cost transformation leader, Rima Kotecha. So let me just start on the next slide by talking about some of the trends we saw across the wealth and asset management industry pre-COVID-19. And of course, that doesn't feel like many weeks or many months ago. Aging demographics, the need for healthcare and education continued to drive the need for financial advice and long-term savings. The longest equity bull run in history, of course, drove fantastic financial returns for many wealth and asset managers. We saw great AUM growth, revenue growth, operating margins across the industry between 30 and 35%. However, these good times were starting to come to an end and were under increasing pressure from a number of economic and cyclical headwinds. More fundamentally, we observed structural shifts in asset management, such as the shifting responsibility for long-term savings from the state to the employer to the employee. We saw stakeholders across the industry really questioning the value for money of many products and services. We saw increasing fee compression, the winner-takes-all phenomena accelerating, technology advancement disrupting much of the value chain, and an increasing focus on financial returns. Each of those structural shifts were individually powerful, but collectively they were driving the industry towards an inflection point, a once-in-a-generation level of change. We were recommending that asset managers took a multi-track strategy to navigate that inflection point and to emerge stronger with an enhanced purpose to serve both society as well as investors and shareholders. On the other hand, wealth managers were continuing to try and satisfy clients' demand for high quality advice, but many of those clients were remaining on the sidelines and looking to move wealth manager in the next 3 years. Our biannual EY research showed that the industry wasn't delivering on the digital experience that the clients desired. Clients were underestimating their move to digital and the industry was struggling to catch up. In addition, the wealth management industry was trying to increase the level of client trust by improving transparency of both performance and fees. The wealth managers were striving towards delivering higher quality investment management across all asset classes, particularly alternatives. And in addition, we're focusing on financing products, credit risk and liquidity. The intergenerational wealth transfer was clearly a key priority for clients and wealth managers alike. But some of that has accelerated, much has changed as a result of COVID-19. Moving on to the next slide. So the last 7 or 8 weeks has seen some significant implications and challenges for the industry as a result of the pandemic, market volatility, and economic crisis. Of course, most of our wealth and asset management clients initially started by focusing on their people, ensuring the health and well-being, both physically and mentally, of their staff, making sure operational resilience and business as usual could continue in this virtual environment we're quickly becoming used to. As a whole, I think the industry has responded very well, undoubtedly helped by some of the planning done post the financial crisis, but the shift to this virtual environment has been generally well executed by many of the wealth and asset managers. The smaller and medium-sized firms clearly struggled more than those very large, sophisticated organizations. But it's not just been about maintaining business as usual, it's about making sure the control environment is robust. We've clearly seen an uptick in operational errors, which have got a greater financial impact as a result of the current market volatility. We've seen increased focus on the oversight of third parties and making sure that all parts of the value chain can continue to operate, even in some of the offshore locations as the pandemic continues to spread. We've seen NAV delays, we've seen swing pricing errors, we've seen cyber risk increase. But operational resilience and business as usual continues. We've experienced some significant market infrastructure stress, particularly in those early weeks where there was significant volatility and trade volumes. We saw a significant increase in trading volumes of 300 and 400% in some markets. We saw a ban on short selling across a number of countries in Europe. We saw regulators warning to reduce volumes in markets like Australia. And we saw some small financial markets close for a temporary period of time, the Philippines, for example. Of course, as the agenda shifted from operational resilience and market infrastructure, financial risk quickly raised up the agenda. Fund liquidity, in particular, we've seen a large number of funds gated or suspended as a result of difficult to value underlying assets, redemptions, particularly in the real asset classes, as well as in corporate bonds. We'll hear more about that from our colleagues later on. We've also seen, of course, heightened credit risk, focused both on sovereigns and corporates. And we've seen increasing focus on product failure risk. There, of course, are a number of guaranteed products still popular across the European countries. We've seen money market funds in particular being under stress, not just here in Europe, but of course in the US, resulting in some significant capital injection, both by the Treasury and by corporates. We've seen stress in ETFs, although broadly they have responded well. We have seen some price dislocation, and we know behind the scenes, large ETF managers are working very hard to make sure they keep the show on the road. We've seen some immediate tax implications for the changing status of funds as a result of changing valuations, and that's caused some concern both for investors and managers alike. Most wealth and asset managers have been grateful for the regulatory forbearance, but navigating the new landscape is proving difficult. Of course, we've seen some immediate financial impact to the wealth and asset management industry of the crisis. It's been interesting to observe the Q1 results where we've seen a clear divergence between winners and losers. We've seen some continue to gain positive net new asset flow during Q1, others seeing significant redemptions. Overall, a reduction in revenue and increased pressure on operating margin. I'm sure the worst is still to come, and one CFO described Q2 of 2020 being very similar to Q1 of 2019. But of course, for clients, financial advice, planning has never been more important. And we've seen wealth managers rush to keep in constant communication with their clients, demonstrating portfolio risk management, providing significant advice, and guiding them through this difficult time. Of course, client communication continues to be paramount and has been a key component of the response of the industry here and now. Let me now hand over to Tony Kirby to talk more about some of the fund liquidity challenges we've seen and how the industry has responded.
Thank you, Alex.
Tony, I think you're on mute.
Thank you, Alex. Sorry about that. Would like to start by saying that liquidity risk, or the risk that a position in a fund cannot be sold, liquidated, or closed to comply with obligations at any time, is not a new industry issue. During the financial crisis of 2008, you may recall how some money market funds broke the buck. Fund manufacturers, resellers, distributors, and services realized just how quickly asset liquidity could evaporate under extreme market conditions. Last September, the European Securities Markets Authority examined just under 300 funds, representing 89% of the high-yield bond market. They issued a stark warning that 40% of bond funds could struggle to cope with a sudden rush of redemption demands. At about the same time, we conducted our own research of 41 asset managers, including 15 out of the top 20 firms by AUM. Let me share with you some results on the slide. As you can see, the good news is that 85% of firms were performing time series trend analyses of the subscriptions and redemptions. 66% were fully familiar with the SEC Rule 22E4, with lesser percentages with similar measures around the world. But only 48% of firms were either installing in supplier solutions to evidence fair value, mark-to-market or mark-to-model valuations, or upgrading the firm's other system components to ensure above all that the right market data was available. Shortcomings arose from poor vendor interoperability, vendors refusing to accept liability, and sometimes poor depot practices when valuing alternative assets. Effective liquidity risk management stems from how firms manage two critical areas, in our opinion. The first, foreseeable product design, where we saw firms paying attention to portfolio structure, redemption fees, anti-dilution levy, dealing arrangements, valuation frequency, and above all, analyzing investor behaviors. Secondly, asset protection in a crisis. We saw firms examining total and partial swing pricing, specifying notice periods, conceptualizing liquidity buckets, defining hard and soft closures and in-specie redemptions, designing gates or side pockets, or arranging temporary borrowing, variety of measures. We found that leading asset managers in the survey were also aware that even mild proactivity could be misinterpreted by journalists in media time. The surprise is that we discovered that only 17% of asset managers in the survey had revised their playbooks to include rehearsals of real and hypothetical wind-down scenarios in advance. This reminds me a bit of banks performing recovery and resolution planning 10 years ago. We heard from Alex just now how COVID-19 has impacted the equity market prices, bond spreads, dislocation in ETF markets, money market interventions in the States, withdrawal of property portfolios and illiquid assets in emerging markets. Governments and authorities are rightfully asking whether market fluctuations or operational non-resilience could trigger systemic risk transfers. So regulators today expect asset managers and wealth managers to act with integrity under all market conditions, not merely tick box compliance, but providing real evidence of how they treated customers fairly. Some houses, of course, that incurred redemption last year failed to adhere to the spirit of the regulations, which we'll drill down to in the next slide. The industry might be in a stronger position now, but what makes liquidity risk management immediately relevant is the compound reputational impact of several property and illiquid bond suspensions. This resulted in investor withdrawals on a large scale. Only last week, the Financial Times reported that 76 investment funds, representing a combined 40 billion of assets under management, had been unable to meet redemption requests. This includes several well-publicized UK property funds and Nordic high-yield bond funds. The redemption pressures due to downgrades, credit downgrades, or defaults coincide with additional regulatory and end investor scrutiny, as you can see on the slide. This is to ensure that firms demonstrate three things. Firstly, do firms have the right substance by way of qualified headcount? Secondly, are firms able to protect themselves in a crisis? And thirdly, are firms treating additional investors and private wealth clients fairly? We see a consistent direction of travel by national competent authorities across the globe pursuing outcomes-focused measures, as you can see. Examples include attention to substance and delegation by the Luxembourg CSSF or the Irish CBI, a focus on harm and operational resilience by the UK's FCA, prevention of investor detriment announced by regulators in France and Germany only last week. But what is new is that regulatory bodies such as the European Securities Markets Authority are starting to introduce new metrics, such as the redemption coverage ratio, in a manner similar to the Basel III liquidity coverage ratios for banks. We see this new quant-led approach signaling a desire by the authorities to apply formalized limits to both stress testing and periodic reporting. And this isn't just about regulation. We see 4 categories of discerning end investors: sovereign wealth clients, pension funds, insurance firms, and corporates. And basically maintaining a watching brief. Some are already suggesting look-through procedures to better understand investment risk exposures and potential for maturity mismatches. Some investors are querying whether outsourcing arrangements or measures to recover data from suppliers are sufficiently resilient. Some are questioning whether shifts in market volatility could impact asset correlations arising potentially from negative oil or negative interest rates when it comes to portfolio performance attribution. And in the latter case, end investors are particularly keen to understand how assets are being priced to demonstrate value for money for trustees. Are monthly returns accurate, for example? How are funds benchmarked against similar funds with the same strategy? A lot has been achieved, and there's clearly, as Alex said, there's more to come by way of actions to be taken. We believe the quality of execution beyond COVID-19 will determine winners and losers. Both end investors and regulators are wearing gaps in management practices on 4 key areas. These areas are, firstly, establishing fit-for-purpose governance, including empowered valuation committees. Secondly, addressing effective and foreseeable product design to prevent investor detriment. Thirdly, evidencing the valuations of liquid assets. And fourthly, performing stress testing against severe but plausible real and hypothetical scenarios. To close, we can see how regulators and investors and journalists are asking whether senior managers and boards really understand how portfolios are monitored and managed under adverse market conditions such as COVID-19. I shall now hand it over to my colleagues Vincent and Christophe to provide you with some concrete insights as to how we're seeing these features deployed in practice. Thank you.
So thank you, Tony. So let's now have a look at how the industry should manage fund liquidity in the coming month and possibly until the end of this year. And then we'll talk about what should be the next step, even further beyond the road. So it's been a long time that there's a broad consensus in the industry, regulators included, that funds and funds managers should develop a strong understanding of their liquidity risk, whether it comes from the asset side of the fund, but also the liability side of the fund. So they should understand their overall liquidity profile, all assets and liabilities combined. Now, the challenge definitely with what has happened, and the examples mentioned by Tony, I think, are quite revealing, is that probably it's the right time to think of this liquidity risk profile using the broad palette of all the liquidity management tools which are available to your fund and which ones are adequate. And this is an important step that I will detail a bit further. So what is the start of that? Where do we start from? But basically, you are requested already by ESMA to provide stress test on your liquidity risk. It's a compliance exercise which is due by end September this year. Now, the challenge is definitely to do that, not just as a compliance exercise, but really implement those stress tests as a tool, meaning that you really embed that into the fund's risk management framework. You give it appropriate resources, governance, you link it also to clear escalation and remedial measures into an executable plan. That's very important. So think of it as a tool, no longer just compliance. Then in that exercise, obviously, it's the right time to think on how we can onboard the lessons learned from the COVID-19 crisis and what has happened in March. Obviously, in terms of severity of stress scenarios, the huge volatility and market plunge that we have seen, this leads to discussing and assessing valuation issues, whether it's about the valuation of assets which are fired sold, or the ones where the demand simply drives out, or also more complex instruments, for instance, derivatives, where there can be valuation issues driving huge liquidity pressure through margin calls. It's also the time about rethinking the scenarios around investor behavior, and here the objective is certainly not to replicate what has happened in March, and just to those specific asset class, but think beyond of whatever could happen, further down the road this year to other asset classes and to your specific investors. And we can think, for instance, of potential runoff on sovereign debt funds, for instance, just investors willing to switch asset classes for whatever reasons. Now, the third point in that agenda is definitely, as I mentioned before, to integrate the full potential use of all the liquidity management tools which are available to you, and concentrating on the ones that you think are appropriate. That ranges from simply having in your fund huge buffer for liquidity redemption, like cash, liquid assets available, but also, of course, swing pricing and possibly extended range for that, to the more special arrangements like Tony mentioned before, gating, suspension, but also side pocketing, and even redemption in kind. So think of building that into a contingent planning of what you would execute in the case the stress scenario occurs to your fund. Now, in that agenda, obviously, it's very important to have a clear view of the trade-off between the liquidity you commit to provide to investors, the investment return that those investors are still expecting from the fund, because let's not forget that investors are in primary shareholders. They are not depositors, they are not creditors expecting to be redeemed. They are looking for a return. And the risk profile of the fund. What does that mean? In the first place, well, taking care of equality of treatment, both for redeeming and non-redeeming investor, very important. Making sure that whatever LMT you use is transparently presented and is tolerated by your specific investors, very important, to gauge what is appropriate for your investor base. Then, of course, as I mentioned before, gauge the potential burden of the mitigation measures you put in place on your investment return. Don't forget that this is what the people are expecting, it's a return. And last but not least, think that if you execute some drastic measures, there are still investors who like to stay in the fund. And you have to anticipate what the partial or total liquidation solution that you put in place means for them, and what can be also the impact on the investment guidelines and risk profile in case there are investors remaining on board and interested in the long-term strategy. So this is why we represent that basically as Venn diagrams with 3 dimensions, and you have to work with those 3 dimensions all together. The next slide, please. If we try now to think a bit beyond and looking for what you should do in terms of liquidity management and what we can expect as industry trends, definitely it will be about embedding liquidity management into the product design. And what we can expect is that when you launch a fund, this is already actually live through the ISCO principles, but that you would come to the regulators with a demonstrable contingent plan about what you would do in case of liquidity pressure, executing all these LMT measures that you would have thought. And this is expected to be part of the pre-launch approval and be even more, strengthened in coming months and years. Definitely also as part of that agenda, it will be the end of the free lunch on generous, unrestricted redemption rights and mechanisms provided to investors, especially in the case where you have less liquid asset class or obviously unliquid asset classes. That will be scrutinized not just by regulator, but we believe also that investors will look skeptically if you provide unlimited liquidity for something which is obviously not so liquid. It means that you have to take care of, obviously, of immense disclosures about the liquidity risk, and don't just do it from a legal standpoint, compliance standpoint, but think also of the implication for the distribution in terms of raising investors' awareness on the potential liquidity constraints of investing into that fund. That's probably the best means of defense you can put in place. Then, as an additional item, you may expect the regulators to put a little bit of pressure on you through requesting data on your liquidity risk, and do so more and more in the form of templated reporting, standardized them to report on stress test results, but also on other liquidity risk metrics. That has already started by some ESMA requests for data and a similar request in different jurisdictions. Another item, obviously, is the independent validation review of your liquidity stress test models. In the current guidelines, it is required to be performed independently from the portfolio management, which is quite obvious from governance standpoint. But if we think of the regulatory approach imposed to other important risk models, such as UCITS FAR, for instance, you may think a bit further and anticipate that it will be requested to be independently validated by someone else than the risk management function who has designed the model. And last but not least, what we may also expect, as Tony mentioned before, is that at the end of the road, the regulators will come back, forcing to implement prescriptive liquidity monitoring metrics and perhaps some limits. Now, I will leave it to Christophe to address the valuation issues. Thank you.
Thank you, Vincent. So in terms of valuation, well, the good news is that how to perform a valuation in terms of techniques, especially, has not really changed during the crisis. What the challenge was more with the inputs into the valuation, namely the market data and asset-specific information, which was either not available or not relevant. So a couple of examples here. So in the first instance, there are situations where you have absence of relevant market data to perform your usual valuation approaches. In this example of a long-term debt portfolio, where the valuations were based on recent comparable transactions, if there are no transactions anymore because the markets have dried up, well, then you need to consider other valuation approaches, and we will see what that means in terms of switching to another valuation techniques in a couple of minutes. And also in terms of the time gap that may exist in terms of the information provided. Well, think about a fund of fund where you have to report on a March valuation and the underlying funds being based on December valuations. So there is a disconnect between valuations prepared on a pre-COVID basis and your fund valuation. And finally, also an example of assets that have significant changes to their business plans assumptions. So typically, the example that I took here was of a hotel group, so whereby the existing hotels would finance the growth of the new development projects. Well, if that cross-financing is not possible anymore given the current crisis, well, that may require a significant revision of the growth ambitions and thus the business plan. So on the next slide, so in terms of what needs to be of high attention is obviously, and as Anthony already had mentioned, the valuation governance. Whenever you have changes, for example, into your valuation policy because you have a new valuation approach, well, you need to be aware of potential abuses. So valuation governance is very important, having an independent review, sign-off, and so on. When you have new valuation approaches due to this changed environment, well, when you are changing from one approach to the other, you want to avoid that there is a big gap between your valuation of the past quarter and your valuation of the current quarter. So to do that, you need to calibrate your new approach to your old valuations. Obviously that also leads then to revisions of the valuation policies, which needs to be updated. In terms of changing business plans, well, I imagine that most of the asset managers on the call will stay close to their investments, and over the next coming weeks to see what are the different changes, impacts that the underlying assets may have. So you will also want to ensure that there is a coherent view on that is across your underlying investments. So you may want to support them and also ask them share your views on the crisis with them, so that you have a coherent view throughout your investments, especially if they are in the same sectors and so on. That also leads to some reviews that needs to be done in terms of the models. As you're all aware, so in terms of the European AFMD, well, every model needs to go through an independent review. So make sure that you address them. And when we are supporting our audit colleagues on reviewing evaluations of their clients, well, it happens that sometimes models were updated and not properly verified, and that may lead to errors during the year that needs to be corrected subsequently, and that may be unfortunate and costly to do. Yes, the specific adjustments. That's when you're in the heat of a crisis. Well, you need also to be reminded that documentation in order to explain the changes that you have brought to your valuations over this couple of weeks, so that you remember them when you are being asked the questions subsequently. And then finally, disclosures. I think there is a lot that can be said, but I think it's important to convey the right messages to your investors. So we see a lot of thoughts being around the disclosures in terms of what can be disclosed and so on. So with this, I would hand over to Alex for the next part of the presentation.
Thank you, Christophe. So if the now is about operational resilience, managing some of the financial risks, what's next for the wealth and asset management industry as a result of COVID-19? Well, it's clear that operational resilience has been maintained, but we're not out of the woods yet. I think there is increasing concern about the pandemic spreading to some of the offshore centres around the world and of what the impact of that might be on the operations and value chain of wealth and asset managers. We've seen a number responding by bringing more of that activity onshore, making sure there are other plans in terms of BCP to be able to continue operations in the event that we see a greater increase in the pandemic across those locations. Of course, for other countries, and we take our lead from Asia and China in particular, there is the return to work planning. What does that mean for wealth and asset managers and their interaction with their clients? Of course, that's not going to be binary. We see that being a slow and smooth transition back to the workplace. And of course, that will provide a new challenge in terms of being able to operate in this hybrid scenario of teams operating both virtually and in the workplace. Of course, client communication continues to remain critical throughout, and being able to engage with existing clients and grow new clients is clearly critical to wealth managers and asset managers alike. Of course, digital transformation was important pre-COVID-19. And as our research showed, particularly in wealth management, the industry was behind the demand and desire of the end investor. I think when we look back on this crisis, we will see that those wealth and asset managers that had a superior digital experience for customers are the ones that won or maybe lost less as a result of COVID-19. Therefore, we are already seeing an increasing investment in the digital transformation of services and products and communication from wealth and asset managers to their customers. A real increasing focus on being able to create an enhanced digital experience for the client base. I'm sure that will start to become a significant prerequisite for those that win as a result of this new environment. We've also seen investment risk raise up the agenda of many wealth and asset managers, similar to what we saw in 2008 and 2009 after the financial crisis. I'm pleased to report that the industry has clearly improved in its investment risk management, but there's still more to go. We see wealth managers continuing to invest in being able to provide a holistic whole of client perspective from an investment risk angle. We see asset managers continue to implement new technology to provide an enterprise-wide investment risk perspective across all issuers, across all client portfolios. Clearly, more technology and enhanced data is required to provide the right level of reporting and analysis to enable those wealth and asset managers to make the appropriate decisions. On the positive side, we're seeing new opportunities for product development. Of course, the government stimulus is being transmitted via the banks, but of course that capital injection won't be sufficient to support all corporates and all segments of the market. We're already seeing a number of wealth and asset managers start to invest in launching new debt products in the listed and in the private debt space to be able to supplement that capital injection to what we're seeing from government stimulus. We're also seeing, of course, the resurgence of some hedge fund strategies that have done particularly well over the last 7 or 8 weeks. Macro strategies, for example, have done particularly well. But of course, all of this investment comes at a cost. We already saw significant operating margin pressure. The market volatility, the reduction in markets, the redemptions, all adding to the strain as revenue starts to decline, as costs remain fixed and operating margins become under more and more pressure. And to come to one of the questions that one of our audience participants asked, will we see this time a much more significant transition of this industry to a new operating model? I believe the answer is yes, and it's yes because of necessity. Because of that pressure on operating margins, we're going to see a much greater focus on strategic cost transformation, leading to a new operating model like we've never seen before. And this is going to be required to ensure that wealth and asset managers can deliver the new products and services of the future while maintaining operating margin. We thought we would see this type of response in 2009, but then we saw the beginning of the longest equity bull run in history. So again, back 10 years ago, this was only a small transition. We believe now there'll be a much more fundamental transition around strategic cost. Let me now hand over to my colleague Rima to talk about how it will be different this time post COVID-19.
Thank you, Alex. There's never been a more important time for strategic cost transformation. From our perspectives, cost transformation needs to achieve 4 key objectives. Firstly, reducing overall cost from the cost base. Secondly, adding flexibility to the cost base, so tilting to a more variable cost model to enable organisations to dial down during periods of outflows. Thirdly, adding scalability to the cost base, so reducing unit costs associated with growth, and levers such as large-scale technology and data change can support this. And finally, achieving effective cost controls and processes to appropriately incentivise the right behaviours and mindsets around cost. In terms of how to achieve strategic cost transformation, we believe a multi-layer approach is required. Firstly, considering the strategic drivers of costs. So which clients does an organisation sell to, with which products, in which geographies and via which distribution channels? Secondly, the structural drivers of costs. So this is around how a firm operates. For example, how is it organised in terms of layers and spans of control? So to what extent does it outsource? What's its technology architecture strategy? For example, in terms of make versus buy, in terms of single vendor versus multi-vendor. And similarly, what's the data architecture strategy in terms of physical architecture versus cloud? And finally, addressing the tactical drivers of costs and using levers such as end-to-end process redesign and intelligent technologies to drive cost out of the existing operating model. Many of you will recognise that these levers aren't new, but what is new is threefold. Firstly, there's a much greater recognition that the strategic drivers of costs must be addressed this time round. Historically, managers have looked at the structural drivers and the tactical drivers of costs and achieved cost transformations to varying degrees of success. But given the outflows our industry has experienced in the first quarter, the impact on revenues and the anticipated impact on operating margins, it's critical to focus on the strategic drivers of costs now. Secondly, it's about greater focus on high quality execution and ensuring that the benefits identified at the beginning of such programs really do deliver throughout the transition. And thirdly, it's about using these levers in a new way across a wider proportion of the value chain and with a broader ecosystem of providers. So for example, outsourcing trade execution to a traditional TPA, outsourcing non-core services such as regulatory reporting to a RegTech or even someone like EY, and using intelligent technologies, not just in core processing and operations, but further up the value chain. Right now, during the current COVID pandemic, the focus is rightly so on employee welfare. So many organisations are focusing on non-personnel costs. COVID has forced our industry to move very quickly to digital processing and away from paper and post. Organisations are looking at procurement contracts and the cost of licenses. And some are even questioning, should we renew the cost of leases on our property as we prepare for new ways of working beyond the pandemic? These initiatives are helpful and will go somewhat of the way, but they are not sufficient to recover the operating margin loss our industry is facing. Now more than ever, there needs to be a focus on greater transformation, taking a new top-down approach as well as a bottom-up. I'll hand back to Alex now.
Thank you, Rima. So if that's the next agenda for the wealth and asset management industry, what's beyond? For a long time, this has been an industry that's focused on providing products rather than solutions to clients. I think now is the time for the wealth and asset management industry to reorientate its business to put the customer at the center. That means a greater understanding of the customer needs. It's about creating solutions that can be provided on a mass customized basis at the right price point. That pivot from product provider to solutions partner is going to be critical as a response to this crisis and the emerging trends. It's also time that the investment proposition is reimagined. I'm sure we'll see a resurgence of active management as a result of the market volatility we've experienced over the last few weeks. But active management will be done in a different way. It will embed big data analytics, artificial intelligence to augment portfolio managers to make a higher quality investment decision. We already saw the beginnings of that trend emerging pre-COVID-19, and we believe that will continue to accelerate. Of course, we'll also see smart beta or factor investing continue to grow. We're already seeing the launch of different thematic funds in that smart beta space. We believe that that will be a potential disruption to both the passive end of the barbell and the significant high alpha. Alternatives have slowed over recent weeks, but I'm sure that the private equity, private markets will continue to flourish post-COVID-19, and we'll see again a new product development cycle in the alternative space. Clearly, pockets of growth continue to exist, not just in alternatives, but also in new geographies. China will continue to accelerate in importance as a growth engine for the industry. We've already seen in the last few weeks an acceleration of the market entry into China by a number of international managers based in the US or in Europe, either through joint ventures or through going alone with a wholly owned foreign entity license. China, as it's emerged from the crisis faster, markets have been more stable, will continue to be an important source of growth for the coming years ahead. And of course, for those that have always struggled for organic growth, but been propped up by an equity bull run, we're going to see a more strategic dilemma, and that will probably be addressed through further consolidation. Consolidation and M&A transactions, either for reasons of scale, of new capabilities, or geographical reach. For a long time, we've been talking about a wave of consolidation in wealth and asset management, and I think that will be another strategic response to the current crisis we find ourselves in. But of course, investors are looking now for more than just a financial return, or a financial return not at any cost. And the importance and evolving environment of ESG investing is going to be critical. Let me hand over now to Gillian to talk about how we see that going forwards.
Thanks, Alex, and good morning, everybody. So as head of sustainable finance across financial services, I get to see what's occurring across the whole industry. And I can honestly tell you that whilst initially firms were focused on crisis management, clearly, sustainability and ESG is now becoming more and more of a topic of conversation and a strategic imperative as firms consider the next and beyond phases. Sustainability advocates have welcomed obviously many of the differences that we have experienced in recent times, such as lower carbon emissions, reduced global travel, local sourcing, heightened employees' importance. And now firms are considering how they respond to this and how they evolve as a result. So on this slide, we've split into two sections how we believe some of the likely ESG and sustainable finance outcomes for wealth and asset managers will play out. On the one hand, what the wealth and asset management firms will do as corporates, and on the other hand, how the wealth and asset management products and service evolve as a result of C-19. So at the corporate level, many firms have already announced that they will not be taking advantage of any stimulus packages, but they do expect to retain autonomy over their dividends, over bonuses, and over pay. However, we have seen that the industry is very keen to play a role in the stimulus management. So, for example, a lot of the stimulus packages that are out there at the moment are in debt or are planned to be in debt. And over, let's say, a 5 or 6 year period, is this the most appropriate financial packaging for all of this financing? And if not, should it be refinanced? Could it be refinanced and restructured? And what would the role of the industry be? So, for example, would some of it be refinanced from debt into equity? And what would the role of the wealth and asset management industry be? Secondly, under corporate, we've highlighted putting investors first during this period. So we've already mentioned about the huge volatility in the markets and, you know, some areas of illiquid where liquidity has been stretched. So communicating with investors, being transparent with investors and putting them at the heart of investment decision making will continue to be critical during the future phases as well, particularly as investors move to more of a risk-on position, or maybe as investment managers move to investing in value investments. And regulators also seem to be equally focused on this, on the consumer protection agenda and on the fairness agenda. So, for example, IBOR and the UK value for money deadlines currently look unlikely to shift. We also believe that firms' purpose and wider societal value will evolve. So currently, putting the best interests of their investors at heart, how will they serve the best interests of wider society? The winners will evolve out of this with a new sense of purpose and a new societal value. And, you know, a very obvious example that we can think of is how the people agenda in firms has radically changed, and the importance of employees and people within the businesses is becoming a completely different proposition than it was historically. So moving on to products and services more specifically, we've obviously seen evidence that ESG funds have outperformed some of the classic indices, such as the S&P 500, during the initial phases of the crisis. And going back to what I said earlier, some of these evidences around environmental, societal, and governance factors that have actually gained importance across the whole of society. And we see those factors very much gaining importance in the investment risk process and in the due diligence process. I guess one thing to put out particularly is, whilst that societal and governance factors have raised in importance, we don't see that environmental risks will go away, and clearly that is still an extremely important and urgent issue that many firms are dealing with. We also believe that investment governance and stewardship will become enhanced and will evolve more rapidly during this period. In particular, I think the evidencing and reporting of governance processes and stewardship processes in a much more open fashion than was previously the case. A couple of final areas I wanted to touch on. One was the EU regulation. So if you take, for example, the EU regulation on sustainable finance, that is progressing at speed. So, for example, the taxonomy requirements for funds, which are due to be implemented December 21. Clearly, we see that firms will need to put a lot of effort in, whilst also managing through the C19 cycle, and therefore putting a further emphasis and importance on the rapid evolution of ESG investing. And then finally, just a couple of examples of ESG investment opportunities. So, perhaps we'll see new categories of funds or funds that have a larger proportion of allocation to societal standards, health and well-being, access to digital infrastructure, for example. And also, as government recovery plans are developed and unveiled, this can provide opportunity for wealth and asset managers to get involved in strategically important infrastructure investment, again, such as healthcare or the digital infrastructure. So all in all, we see sustainability and ESG as strategically important factors that managers will incorporate into the next and beyond phases of their plans that they're currently drawing up. Alex, back to you.
Thank you, Gillian. So it's clear that asset owners, institutions, high net worth individuals, retail investors need financial advice and investment solutions now more than ever. It's clear that clients have a real desire to adopt digital channels, both during their onboarding as well as through the life cycle of their relationship with a wealth manager or an asset manager. History shows that this is an industry that moves slowly. However, we believe that COVID-19 will be the trigger that creates the impending inflection point and creates more change in the next 5 years than we have seen in the last 25. It's clear that wealth and asset managers are going to have to navigate this unprecedented level of change, which has not always been their area of expertise. And all of this will be carefully watched by many stakeholders of our industry through a broader ESG lens. It's clear to us at EY that we won't come out of this crisis the same way that we went in. Appreciate your time listening. Now let's turn to some of the great questions that you've asked throughout today's presentation. Maybe, Tony, I could start with you. A question here about whether regulators regulators are asking managers who are investing in open-ended funds featuring illiquid assets, whether they truly fully understand their obligation to protect investors in a crisis. How do you see that playing out in the future?
Alex, that's a good question. It's very pertinent right now. And I mentioned earlier the pivotal importance of governance, of foreseeable product design, of stress testing, and above all, valuation approaches. And we've seen this in some parts of the world, like Singapore and Hong Kong and Japan, already querying whether compliance and risk functions provide sufficient, robust challenge. And you mentioned the world of investment risk earlier. If we're not careful, you'll get the world of investment risk talking Star Trek and the world of compliance talking Klingon. So the three things I'd recommend, which have come from the regulators as we move forward under both COVID-19 and beyond, is that firms take the trouble to demonstrate their expertise, demonstrate the independence of each of their functions, and thirdly, last but not least, document everything. Yeah, I basically say that's the quick and dirty answer to that.
Great, thanks, Tony. We've received a number of questions about the potential consolidation that we might see in the industry. Why, where, and when? So let me maybe take that one to start with. I think what we have seen over the last few years and increasingly the last few weeks is that it is the bigger wealth and asset managers that are continuing to win in this current market environment. And after many years of debate, it appears that big is best. We did some EY research about a year ago that showed if you're a manager with more than $1 trillion of AUM, you are significantly more efficient than if you are a manager with 500 billion or less. Not only are you more efficient, you also see smaller number of redemptions as we see large institutional asset owners try and move to a smaller number of strategic partners, therefore opting to move assets between products, but within the same stable. I think that will continue. When we look at wealth managers in particular, there is clearly a very strong correlation between size and profitability, with many of those small wealth managers and private banks really struggling for profitability. So now with this market correction, the volatility, the investment that's required to deliver on the customer experience, I think we're going to see many of those smaller players that maybe have been struggling for organic growth for some time really start to look at their more strategic options in terms of combining with other bigger firms. I think we'll see much more consolidation at the big end, as well as across that sort of middle market that has been struggling for some time. But a lot of that struggle has been masked by strong equity markets over the last 10 years. I think now is the moment where we're going to see that consolidation. Of course, doing a deal in this current virtual environment is clearly not easy. And we've seen in our transactions business, a lot of deals start to be put on pause. But as things start to return to normal, then of course transactions will pick up. And I think over the next 12 months, we'll see a flurry of further M&A activity for reasons of scale, capability, and geographical reach. Now, let me come to another question about ESG, and Gillian, to come to you. And a question asking, what are the key priorities for wealth and asset managers now in terms of ESG and what their clients are expecting?
Great question, Alex. Thank you. So I think there's a few things here. Greenwashing is clearly something which is, not what you want to create a reputation for. I think tick box exercises equally is not on the agenda. So where we really sort of see this going is firms being authentic to themselves in their own purpose and strategy, and also authentic to their investors in the investment strategy. So it's really, Alex, I think, a matter of creating an ESG strategy, a sustainability strategy where you are, and we've seen several announcements on this, creating long-term value for your investors. And actually that does stretch out a little bit to all stakeholders. But also, I think, but making that very authentic. So not having it as a tick box exercise, not having it as something which you are trying to push because it's the latest trend and provides you with decent margins, but going back to using your strategic resources and thinking authentically about how you can deliver those products and services. The second other really key element here is around the client experience and the client service. So we definitely expect to see an uptick in transparency, communication, reporting, and engagement with investors as part of the whole ESG journey. So I'd say in summary, I think the authenticity is one area, and then the client communications and client servicing is another key area.
Great, thanks, Jill. There's one question here on cost reduction and strategic cost transformation. Rima, coming to you, asking, what are the key sort of difficulties with cost reduction? Is it the identification or is it the execution, and how do you see that evolving?
Thanks, Alex. So I would say the difficulties are predominantly in the execution. So I think too often we see our clients undertake projects that identify benefits up front, but really struggle to then deliver on them. And this needs to be addressed in a twofold way. During a programme, it's really important to set a clear baseline up front, and it's really important to tie initiatives that you identify back to the P&L so that we can ensure that items and initiatives are not being double counted. And then during the delivery, it's about having a clear benefits tracking mechanism. So on some of our previous programmes, we've had results management officers alongside programme management officers and had finance very closely involved in that execution.
Great. Thank you very much, Rima, and thank you to everybody for your attendance today on our webcast. If you have any further questions, then please feel free to reach out to us on our contact details you can now see on the screen. We would greatly appreciate your comments, insights, and continuing this dialogue about how COVID-19 will impact wealth and asset management. Keep safe and have a good day.